Hey everyone, so this is video series number 3 of 4. So if you're not ready for number 3 and you haven't seen number 1 or number 2, you gotta go back. So go back, catch number 1, 3 money mistakes, catch number 2, the 4 ways you're bleeding money, so that you'll be ready for this one. Number 3, measuring your financial success. So you definitely don't wanna miss any of it. Stay tuned, Eric Miller's up next.
How do you know whether or not you're making financial progress or not? Well, if you operate or run your household like a business, which you should be, then you know that any successful business measures their progress. They use statistics to measure whether or not the business is doing well or not. Well, your household is no different. You have to run your household like a business. And that means that you need to have correct financial measurements and statistics that you're looking at so you can gauge the progress. Now, what do you use? Well, right now, most individuals or business owners are using what I would consider incorrect financial statistics. You're looking at your account statements, your investment portfolios, your credit card statements, your bank accounts, and you're looking at that as the financial metrics to measure your progress. And those really aren't going to give you an accurate gauge of the actual financial condition of your household. So let me give you 4 financial measurements that you should be using. Now in our system, we have 17 different financial analytics that we look at to measure the progress of a household, but I'm going to give you 4 of those. Number 1 is your net worth. Now look, this one can be manipulated, but the net worth, which is all of the assets of the household, including the value of the business, minus all the liabilities, does give you at least some kind of representation of what the household is worth, the market value of the household. So it is a pretty decent measurement. Number 2, income. You should have a metric on how much income you need to make and track that so that you have a target to constantly increase your income. Number 3, debt to assets ratio. The debt to assets ratio basically shows how much of all of the household assets are encumbered by any debt. So it gives you an idea of how leveraged the household is. And then number 4 would be something called an asset protection ratio. If you're a business owner, you're constantly under the threat of getting sued. So there needs to be some kind of a measurement that you can gauge whether or not your assets are protected or unprotected from any kind of loss. If you have any questions on that, we can certainly help. But those are at least 4 different metrics that you should be looking at. And those 4, by and large, will give you a much better representation of the actual financial progress that you're making in your household. So thanks for watching. I'll see you next time.
Hey there, so that was video number 3 of 4. Next up, number 4, the missing piece. You definitely don't want to miss that. So be on the lookout in your inbox because it's coming straight to you in a few days. See you there.